Ever wondered why some people are able to retire early, even starting late? Or have you got those burning questions that ideally, if you have the finances, you would have had a financial expert come to you the comfort of your home to answer those questions for you? If that is you, stay tuned, because today, in our last episode of the 12, this is the 12th financial series that we have had over the past weeks on B3 Inspire, Edem is going to answer some really interesting and crucial questions that our community, B3 Inspirians, have shared either via emails or via the community tab. Stay tuned. Let's break them right down. For joining us. Oh my goodness, this feels like what a journey it's been.
It has been, but it seems like it's flown by quite quick actually. And to be honest, I think when you enjoy something, you don't actually realize that time is flying.
We might be having you back when there's more questions that's coming on. So we're not bidding goodbye.
The world of finance is always evolving. So I'm sure there will be something that will come up, or even I believe that we've exhausted just enough, but there is various aspects and angles of finances that we could talk about almost all year.
Yes.
But here we are with the 12th series and 12 episodes, sorry.
12 episodes,
And so let's dive into what is in this one really, because
you know what before we start, I want to share some of the comments that we've had from some of our audience, our B3 Inspirians, who have shared this either via email or via the community tab.
Right.
So there was one from someone called George. George said, "Thank you for sharing all of this information regarding estate planning. It's very informative and I'm really pleased that I watched this." Thank you. That goes back right to you.
Thank you, George, for watching and making time for it, and for taking the information. I'm sure it will go really far to help you to be able to set yourself really well. So if anybody else haven't done, please make sure you subscribe, you watch, and you look at those other series, not just estate planning. This is one. This is 12th one. The other 11 that are out there. And if you need any help, if you need to improve anything, do finances, to plan, to manage, and also to scale, I'll be more than happy to support.
Vida, as I also said, thank you so much for sharing all of this information. I feel like I need to put things in place. I fear to invest, but this is encouraging me to take that risk. Wow.
There we go. See, you should, again, Vida, thank you for that feedback. Nobody should be alone, especially if you feel that you don't know what step to take when it comes to investing or even managing your finances. It might not be your forte, so why do it alone? That's the reason why people like myself are available. I'm available. So if you need our help, know that support is there.
Right, I've got one from Mary, and Mary says, "This is so informative. I wish I knew this before I retired."
Wow, Mary. When we started this series, right? Retirement planning was one of the ones that I was sort of really looking forward into, considering the fact that at the moment there's 31 billion of money in the UK that is considered as lost pension or my finances or pension that has been unclaimed.
Wow.
I was thinking that after your hard-earned money, you may not know where it is, or we think that is lost, or might not think that it's not accessible. Surely there must be somebody out there who can help people to consolidate their pension, put it together, and really help them to plan for the longest holiday of their life. So I'm at your service, people.
Oh, amazing. Right. There's so many comments, and you know what? We are going to read some of these comments as we progress. But let's start with the
Go
questions.
for it.
Right, from one of our listeners. And the question is, what is the optimal beginner portfolio split in the UK right now?
Okay. I would imagine that they were talking about portfolios like investment or stock market or money
Yes.
market investment portfolio. So the optimal split
Yeah.
would be, well, it will be through diversification.
Yeah.
So basically ensuring that you have the right balance between the reward and the risk. Okay.
Yes.
It all starts from knowing what your risk profile is. Okay. Knowing your risk profile is the beginning sort of the foundational, but it's not the be all and end of it. So it is a guide which helps you to set the portfolio. Now you diversify, and diversification is very important. So you diversify across the asset classes, you diversify across the geographies, and you diversify across the sectors. Okay, so these three areas of diversification help you to reach the optimal level. So diversifying across the asset classes. Could we have what we call the cash? We call what we call the bonds. We got properties, alternatives, and we got equities. These are the five asset classes. So diversifying across all these five asset classes, then diversifying across geographies across the world, because each geography or each market has got its own different stage of economic stage. So if one economy is not doing well and you are in that economy, another economy is doing well, so it helps you to balance things out. And whilst you grow in the portfolio, that's diversifying across sectors. So we've got what we call cyclical and defensive. So that we're talking about areas, for example, when you're into utilities and the consumable, you are in more of the defensive sort of sectors. If you are in the cyclical, you are in areas such as the technology elements, so sort of high growth sort of elements. So having a good mixture of these in there is important. Now you're asking me, oh, so how do I go, where do I do this? So
That's me. Where do I find it now?
The best way to diversify across is just invest in funds. Index funds is the best place for beginners. So invest in index fund, S&P 500. It's an index. So if you go on Hargreaves, if you go on AJ Bell, if you go on Best Invest, you go on Fidelity, Aviva, all of these platforms will have S&P 500 index funds on there. Or even Dow Jones funds on there. Is again another index, or Nasdaq, another index as well that you can invest in. Now, when you're investing in this S&P 500, look for what we call index tracker funds. They're the same thing. So those helps you to be able to invest in multiple companies at the same time. So if you put in £100 into an S&P 500 fund, for example, Fidelity S&P 500 fund, I'm not sort of promoting it, but just give an example. If you put in as an example, it means that you are going to be investing about 500 companies at the same time. They're going to take your £100, let's say £500, and then split it into all of the 500 companies at the same time. So your diversification is broad. They take care of all the diversification I've mentioned previously in that one fund. Okay, so it's easier, and you don't have to worry about is optimal or not optimal, because it's a diversified fund ready to go.
That's excellent. It's basically do not put all your eggs in one basket.
That's pretty much what it is.
Amazing. Right. I'm going to take another comment.
Yeah.
So this comment is from Beatrice. She says, I did my mom's LPA myself. It was very simple and it cost only £83. Right. But if someone had more complex wishes, it's better to do it with the professionals.
I agree.
That's a very good advice. And I would like to say to B3 Inspirians, if you would like a help in making all these decisions, get the expert. And I'll highly recommend Edem. Edem's details are below the video. Reach out and Edem would be able to support you and do it really well for you. Should we move on to the next question?
Go for it.
Right. So the next question that I have got, it's a lot of questions about investment. That's really cool. Should I focus on SG funds or sectors, growth sectors such as the tech and energy green? I don't know whether I've got that question correct.
Yeah, I understand the question where
Okay.
this
Break it down a bit.
individual is coming from.
This person knows what they're talking about.
So it all depends on what your proclivities are, your
Yeah.
desires are, what
Yeah.
your objectives are,
Yeah.
and in fact where emotionally you are, because sometimes we always
Mm.
say that take emotions out of investing, but
Yeah.
it's an important aspect of it, which drives when what you like to and not like to, when
Okay.
it comes to your desires really. So ESG funds, we're talking about funds that are mainly investing in sort of the ethical, sustainable sort of growth sector.
Yeah.
So funds or portfolios that do not touch or invest in things like tobacco, that do not invest in
Mm.
things like weapons or arms, or that do not invest in any sort of military companies, or do not touch any aspect of companies that exploit perhaps or abuse children or animals, or don't do animal testing. So
Okay.
these are more sort of
Ethical.
ethical and sustainability funds, or companies. We're talking about companies that invest in things like green, solar energy.
Yeah.
Do not touch so much about the
Looking after the
petroleum,
earth.
and yeah, exactly. So more sustainable growth,
Yeah,
and
that's
that's
right.
what it's all about. That's so. If your desire is that you want to invest in that element of um, business or elements or sector, there are funds that are classified ESG funds.
Mm.
You can absolutely invest in it. There is the only caveat is that might be mindful of the charges in those funds.
Mm.
They require pricey to maintain, because they're quite sort of specialist, peculiar sort of funds. And be
Mm.
mindful also with the growth element as well. Make sure that any sort of growth or their past performance, normally we gauge the future performance
Mm.
by the past performance, although they are not the same.
Mm.
Future past performance does not equal future performance, but it serves as a guide, and especially if they're using the same mandate. So these funds, know what your returns objectives are, and then make sure that they are according to their historic performance is according to your returns desired. So those are the ESG. Then we're talking about the growth, which are the tech side of things. So there are funds that have got, will have things like technology in it. So they'll
Okay.
have things like UBS Technology Index Fund. It means that it's a
Okay.
fund that is purely investing, or I've got a huge allocation of the funds in technology, in the tech
Okay.
industry. Investing in things like the Microsoft, the Google, or
Mm.
Alphabet, or in the Netflix, or so Amazon, mainly techie aspect of semiconductors. So, and then there are other funds that also that are growth. Normally, the growth
Mm.
funds tends to be quite equal to the tech or technology
Okay.
sector or funds. So you normally will see, again, maybe you might see things like Aviva or LNG growth fund. It means that
Okay.
it's funds that has got a mixture of technology, mixture of
Mm.
consumable, mixture of healthcare. So companies that by do by they doing, or the fund manager have done the technical analysis, they
Mm.
perceive and believe that those funds will grow quite quickly.
Okay.
So or sometimes startups that can grow quite
Mm.
quickly. Example is like when we had the COVID time, Zoom was a
Zoom.
startup,
Yeah.
and it grew significantly over
Mm.
100%, and over. It grew quite massively. There were other companies that there are, so EV companies, I mean electric vehicle companies, that grew significantly as well. So those are what we call the growth fund. So look out for those ones. So it depends
Amazing.
on what your desires are and what your investment objective is, and you will know where you should invest.
Excellent. If this video has provided you with value, I would like to remind you to Subscribe to B3 Inspire. Share it with someone who needs to hear this. And don't forget to hit the notification bell so you do not miss any videos from us. Would like to take another comment. So this comment is from Fulera Abaya. She says, thanks for the knowledge gained. Keeping it in mind, without goal, there is no goal. I really like that.
That's good. Yeah.
And we've got another comment, which is from someone who is it a Foremanus 979. She says, well done for this great video. I am learning so much. Amazing.
Yeah.
Right. Let's go back to questions. So I've got another question from one of our listeners who is talking all about credits.
Okay.
Your credit score and how to master debt management. I think it's from that video we did about credit score. So this question is, how can I raise my credit score by 50 points in 6 months?
Great question. So, easy wins. If you are in the UK or speak more from the UK, just make sure you're on the voters register quickly. Overnight, it will just turn things around, especially when it refreshes at the end of the month. It will turn things around quite quickly. So that's the first thing that you've got to do. The second thing that you've got to do is that check your credit profile to ensure that there is no mistakes in there. Yeah, so to make sure they've got all your details correct. And if they have, you can basically apply for them to correct it for you. That will also bring things up quite quickly. And the other thing as well is that make sure that you are keeping up for the next 6 months, keeping up with all your repayments and your bank account. Very, very important. Make sure you are keeping up with any repayments that you've got, the direct debit and standing orders. They do not bounce back. Very important. If you've got any loan agreement, any credit card agreement, keep up with it. Make sure that there isn't any sort of late payments. Even for your credit cards, there isn't any registered at all. It will help to be able to improve and to get things going for you. And the other thing I also want to mention as well is that if you have any kind of, or in the past have been affiliated or have a joint credit with anybody, a file to have that separated, because especially if you do not know what their credit score is, because anything that they would have had or in the past you would have had together, depending on their credit score, it can impact your credit score as well. Very important. So make sure you do that. And then if you have any sort of credit card, make sure that you are spending below the limit. Normally, they will say that...
Is that 50%?
That's correct. Make sure you don't spend anything more than 50%. Very important. In fact, as much as possible, make sure the spending limit is somewhere within the region of 30 or 35%. Okay? So that you are within that limit. It shouldn't be anything more than that. Because if it's anything more than that, they think that you are relying on credit. And mind you, any credit that they've given to you or your credit score is an estimation of how well they believe you can manage risk, or how well they can entrust money to you or credit to you. So if you are managing what you already have really well and keeping within the limit by that 35%, it means that you are not relying on credit. In other words, in the future, if you're applying for more credit, it means that they can trust you to maintain or to pay back your credit as quickly as possible. Very important. And lastly, if you have any intention to apply for any credit within the next 6 months, make sure you don't do too many applications at the same time. So make sure that if you've done one application, just stick with the application. Make sure it all go through okay. Don't do multiple applications at the same time. Just one application for any credit that you want to do will ensure that it doesn't impact your credit score negatively in the next 6 months.
Fantastic. Consistency is your best credit boost tool.
Yeah.
Amazing. Thank you. How do I shift from living from paycheck to building wealth?
Great question. Yeah. In fact, whilst we're talking and answering all these questions, I'll be making reference to some of the previous episodes and videos that we've done, because I think this episode might not be enough to sort of hone in all the details. Maybe you'll be able to touch on a high level. But great question. Thank you for that question. Yeah, from paycheck to paycheck, and it can be a bit of a demotivation, especially when you're working so much every single day, and may not even know how to really navigate or even come out of the norm to build something really solid for yourself, and you are not on your own. So the first place it start from is the fact that, and again, it might be a cliche, that if you keep doing the same thing, you end up with the same results or outcome. So I'm glad that at least, and one of the key things I've learned throughout my journey of self-development and learning is that awareness is the key to self-development or growth. Okay?
Knowledge.
And that having being recognizing the fact that you need to build wealth is key and testament to the fact that you are ready to grow.
That's right.
You are ready to go to the next level. So you are ready to develop. So really, I say well done to yourself, really. So the first place where I start from is the shift in the mindset. Changing that mindset, because you are what you think.
That's
As I
right.
say, you are what you eat. But really, you are what it all starts from the mindset. If you don't change your mindset about the fact that I've got to do more, I've got to have more, then you won't be able to have that more. But shifting from that earning mentality to that growth mentality is important. And then shifting from there means that, okay, now I've got to change mindset. It means that you've got to change your routine. You've got to change some of the information that you are assimilating. You've got, if you've never read anything about finance, it's a great time to start to educate yourself. And you asking this question on this platform is testament that you started your learning journey.
That's
Which is
right.
really important. So having that knowledge, having that key fundamental resources to educate yourself, that literacy is the first place which will inform the change of the mindset. So that's important. And then getting other materials, reading on it as much as you can, will help to be able to change that mindset. Once you've changed that mindset, then you've got to find a place whereby you are setting the goals.
That's
Setting
right.
financial goals, clear financial goals. And we talked about that when we did the first episode, the first and second episode. We talked about, so setting clear financial goals. So this is where I am. Where do I want to be in the next 5 years? Where do I want to be in the next 10 years? Where do I want to be, in fact, in the next 1 year? Set that clear financial goal. This is where I want to be. So once you set that goal, then you start to work from there in terms of what are the steps that I need to put down in order for me to achieve that financial goal.
It's the implementation.
Implementation, absolutely important. So the implementation aspect of it will help you to define if you can do it on your own, or if you need to learn more, or if you need to bring somebody alongside you, whether an accountability partner or maybe a professional like myself or somebody else to help you, a mentor, to help you to be able to get to that place where you want to get to. And as we're talking about building wealth, you've got to define what you mean by wealth, okay? And what that will look like when you get there. So that building wealth. So building wealth is there a case of I'm gonna build wealth, and we mentioned in episode 1 and 2 again, especially episode 3, about the 3 lanes of wealth. We mentioned about the fact that you can build wealth through stock and shares. You can build wealth through properties, and you can also build wealth through business. Okay, so you've got to determine what sort of lane I want to be in order to build my wealth. And as we mentioned that, you've got to at least ensure that you at least 2 of these lanes to build wealth. So define your wealth lane. Once you define your wealth lane, then you know what to do. If it's a case of stock and shares, then what's the sort of portfolios I should be investing in? What sort of the accounts or platforms or wrappers we call it, stock and shares, general investment account, SIP or self-invested personal pension. That's what SIP is. Or should I use offshore, onshore bonds to be able to help me to build? Have I defined my risk appetite? So it will define how I should invest. What when it comes to diversification, how should I diversify my portfolio if I'm in the stock and shares lane? If it comes to the aspect of the business, what sort of business can I do, knowing my capability and my abilities? Define it. And again, get the expert around you, surround yourself with the right people to help you to get there. If I'm on the property lane, what sort of property or estate building strategy do I want to employ? Do I want to go into sort of baby buy to lets? Do I want to go into Airbnb? Do I want to go into capital projects where I buy properties, do them up, and
Social
then flip it and
housing.
sell? Social housing. Do I want to go into maybe storage, renting out storages? What's property strategy can I develop to build my wealth? So once you know your wealth lane, key, and we mentioned this over the whole episode, consistency. Be
right.
consistent with whatever lane that you choose, which will help you to reach that goal. And again, because you've set that target, you set that goal, when you are building consistent, when you get there, you will know. If you don't set that goal, when you get there, you will not know. So these are some of the sort of the easy steps, some of the practical steps that you can take and to be able to get to that stage where you realize that I am building wealth.
Amazing.
And you get there.
Fantastic. Wow. And I love what you said. It's about being consistent as well. It's that discipline.
Absolutely.
Excellent. Edem.
Hello.
It's interesting. I was wondering why I was struggling to read some of this comment, and I realized that I wasn't wearing my glasses. Okay, now I can read properly now. Right. Okay. This is a comment from Nana, and this person says, "This is timely. Thank you both for all the tips." And this was on the investment video. There is another comment from Gloria Osborne who says, "This is amazing. Thank you." Right, should we go to a question? Sure. Right, okay. So the next question that I have got here is, this person says, "I am in my 40s and I have no pension. Can I still retire at 65?
It's possible. Ooh. It's possible, but it might be steep. But so just to give an example, there's a client that I dealt with just recently. That basically invested. What a good scenario, really. And she had invested in personal pension. When she invested in this personal pension, talking about more than 10 years ago or so, she invested in personal pension. Started putting £500 in there for 7 years. So consistent over the 7 years. So it grew. At the end of 7 years, she said, "Oh, I had enough. I've got other projects I want to do. I've got other things, money commitments." So she stopped and never bothered put anything more into it. I had about £56,000 or so in there, and with the returns at the time, and I left it. And then she went back to, I said, "Well, let's do a review," because one of the review of a pension plan for retirement and all of that. Went there to her, she was shocked because she had never really gone back to look at whatever I had done, because we were thinking about other things, other ways to retire.
Surprise.
And she went there recently, pulled out details, and she was like, she screamed. That's what she said to me. She said she screamed. That now is averaging £186,000.
Wow.
Without having to add anything to it after the 7 years of putting that £500 in there.
I mean, that's a real passive income.
That is the power of compounding. So it is possible. And mind you, 40 to 65, you have got 25 years into 25 years to your advantage.
Yeah.
Let's not rely or dwell on the past and what has not. Let's dwell on what we have left. 25 years, you've got some great 25 years in there. Within that 25 years means that whereas maybe 30 years ago you could have started with maybe £100 or £150 a month. At 40 up to 65, it means that I probably may have to start investing about £500 or more into it, especially if you are self-employed or you got your own business. Now, if you have, for example, you're working with, you're employed, working with the company, I would say subscribe to the workplace pension, because by subscribing to the workplace pension, apart from your contribution, your employer will also make contribution to your pension pot, and then also your rich uncle, HMRC, will also make contribution as well for you via the government relief. So putting accumulating all of that means that you have some really good starter to in your pension pot. Now, which means that because of maybe limitation or restrictions, that's to because your employer might not match any extra that you put in there.
Yeah.
Then start your own private pension through a self-invested personal pension SIP.
Yeah.
And then because you are doing that at the age of 40, instead of £500, if you're on your own, working your own business and all that, and because you have started the workplace pension, you means that the amount that you will put in there will not be that steep. So it means that probably £350 or £400 a month would do, in order to make sure, again, you will get your contribution, HMRC contribution in there, will ensure that you are growing your personal pension pot or your pension pot in general over the next 25 years. Now, so that's one strategy, but it's that alone might not be enough. So I'll encourage you, if you can, to leverage on one of the lanes of wealth. If you go to episode 11, it's all in there.
Yeah.
So, for example, you could leverage on real estate and start investing in real estate. Define what real estate strategy you want to go into, property strategy you want to go into, or if you want to invest in some sort of business, a really quality high returning dividend business, whereby you will be what we call an angel investor. So I would imagine that if you've not been in putting anything aside into your pension, you would have been saving some money. So the money that you're saving, again, after you've done your due diligence, you can become an angel investor, give your money to this business, get some form of collateral to guarantee that your capital will be protected. And over time, they will be giving you dividend or return over the next 25 years. So as the business grows, it means that your investment also grows with the business. So that, again, it's another income or strategy for your retirement. Now, the third aspect of as well is that because you'll be 65, thinking about retiring 65, yes, it's possible. I would imagine that maybe it would be your state pension age or closer to your state pension age. So your personal pension, workplace pension, and that lane of wealth that investing in, whether in the business or in the property, plus your state pension, should help you to be comfortable and should have enough for your retirement, which is the longest holiday that you have. So yes, it's possible, might be steep, but again, will not rule anything out. Better now than not doing at all.
It's never too late.
Not at all.
With smart savings and investment, you can close the gap.
Yes, absolutely, you can close the gap. You can. So I always say to my clients that there's always a way. There is always a way. Do not just be open to all options. Let's explore it. And if it's according to your risk profile, by all means, we help you to implement it. Again, there's nothing that can be implemented or be done without your involvement. To put it nicely, to put it in a better way, without your involvement, because you know the old saying that it takes two to tango. When it comes to financing, financial planning, don't leave everything to the financial planner, financial advisor, wealth manager. Please get involved in it. Ask the right questions. Do your bit of background, so reading, get education, and everything. You being on a platform means that you are getting the education that you require, and ask the right question. Get that regular reviews, because again, it's you and it's your money, and the expert helping you. They should always help you to your advantage, and that should be about the FCA rules, treating customers fairly. If it's not to your advantage and you're not happy with it, by all means, get a different sort of perspective, what we call a second opinion. And if you're happy with that, go with that other person. But always, one of the great advice I always say to my clients when it comes to financial advice, I don't want to waste your time. You also don't want to make sure that you're wasting my time. So we want to make sure that everything that we're doing, we are equally involved and making sure that we're working towards a common goal, ultimately to your benefit.
That is excellent. Thank you so much for answering that question so in-depthly. Thank you. If this video has provided you with value, I would like to remind you to subscribe to B3 Inspire, share it with someone who needs to hear this, and don't forget to hit the notification bell so you do not miss any videos from us.